Barbara was 67 years old when she learned the most expensive lesson in retirement. She had worked at the post office for 28 years. She did what responsible people do. She showed up, she paid into the system, she retired modestly, she lived on Social Security and a pension, and every April she handed the same stack of papers to the same preparer, paid whatever number came back, and assumed that was simply the price of being honest. One year that price was $900. She should have owed almost nothing. Now I want you to think about how dangerous that sentence is. Not because $900 is a fortune in Washington, waste that before lunch. It is dangerous because Barbara did not lose money from speculation. She did not lose money from greed. She did not lose money from a scam. She lost money because the tax code contained protections designed specifically for somebody in her situation, and nobody bothered to claim them. That is the kind of mistake I have spent my whole life trying to avoid. When I buy a business, I do not like surprises. When I read a balance sheet, I do not like mysteries. And when I hear retirees say, I just give my paperwork to somebody and hope it is right, I hear the same thing I hear from investors who buy stocks they do not understand. They are surrendering the economics without realizing they are surrendering the economics. Retirement taxes work exactly that way. Most people over 65 believe the big financial battle is already behind them. They think the hard part was saving the money. They think the dangerous part was working. They think the tax code becomes simpler once the paycheck stops and the pension begins. What actually happens is more subtle and more expensive. The government built a series of doors into the code for retirees. Some of those doors reduce taxable income. Some of them keep income from becoming taxable in the first place. Some of them lower the tax bill dollar for dollar, but those doors do not swing open because you had a hard life, or because you were a teacher, or because you served at the post office, or because you finally reached the age where your knees hurt when the weather changes. They open only when somebody knows which box to check, which form to attach, which transfer to make before the deadline, and which threshold to measure before filing. That is the whole game. The gap between the retiree who keeps more of what they earned and the retiree who keeps feeding the IRS every April is usually not wealth. It is not sophistication. It is not a family office. It is a checklist. And the problem with checklists is that most people do not build them until after the loss. So let me give you the mother line right at the front. There are 5 places where retirees over 65 lose money over and over again. The first is the age adjustment. Most people assume is already on the return when sometimes it is not. The second is the temporary senior bonus that is new enough to be missed and valuable enough to matter. The third is the charitable move that lowers income before income ever becomes a tax problem. The fourth is the medical threshold that looks unreachable until you finally add up what retirement health care actually costs. The fifth is the old credit buried so deep in the code that many preparers act like it does not exist. If you understand those 5, you stop filing your return like a bystander and start filing it like an owner. That is how I think about money. An owner looks at a business and asks, where does the cash leak? A retiree ought to look at a tax return and ask the same question, because once you are no longer trying to build the pile as fast as possible, preservation becomes the difference between peace and anxiety. A dollar you no longer earn is worth more effort than a dollar you have not made yet, because the only thing worse than losing money in old age is losing it quietly while believing everything is normal. The first leak sits in plain sight. I call it the age box. That sounds too small to matter. It is not. The most expensive errors in finance often start with something embarrassingly simple. A missing date, a wrong basis, a checkbox no one bothered to notice. In retirement tax filings, the age 65 designation is one of those tiny hinges that moves a very large door. Once you turn 65, the standard deduction is not just the standard deduction anymore. The code gives you an extra amount on top of what everyone else gets. For the 2026 tax year, that added amount is $2,050 for a single filer and $1,650 per qualifying spouse for married couples filing jointly. If both spouses qualify, that becomes $3,300 of extra deduction before the government taxes a single additional dollar. Now in Washington, that may not sound like much, but if you are living on a pension, a modest IRA withdrawal, and Social Security, an extra few $1,000s of deduction can be the difference between taxable and untaxed income. It can be the difference between owing money and staying under the line. And because retirement is a game of margins, that difference matters more than young people understand. Young workers think in growth rates. Retirees live in thresholds. That is one of the great truths of the second half of life. When you are building wealth, you obsess over upside. When you are preserving wealth, you obsess over where the lines are. Which line triggers tax? Which line triggers a surcharge? Which line pushes more Social Security into the taxable zone? Which line turns a manageable year into a frustrating one? The age box matters because it moves the line. And there is a second layer here that almost nobody talks about carefully enough. If you are legally blind, there is another addition to the standard deduction, and it stacks. Not maybe, not sometimes, it stacks. A single filer who is both 65 or older and legally blind can add both amounts. That means an extra $4,100 on top of the base standard deduction. A married couple can stack those additions where the facts apply as well. That is not exotic tax engineering. That is basic code mechanics, yet I have seen enough real-world examples of rushed returns, change preparers, new software, and sloppy data entry to know exactly what happens. People assume age was entered correctly. They assume the blindness designation was carried over. They assume the machine is smarter than the process. And then they pay tax they never needed to pay. Never trust automatic when automatic has not been verified. That principle works in investing, in business, and in tax returns. Now, let me take you to the second leak. Because this one is newer, larger, and even more likely to be missed. I call it the temporary gift that expires while people are still arguing about whether it exists. The new senior bonus deduction changed the arithmetic for retirees in a way most people have still not absorbed. Under the law described in the source material you gave me, Americans age 65 and older can claim an additional deduction of $6,000 each. If both spouses qualify, that can mean $12,000 for a married couple. And what makes this unusual is that it applies whether you take the standard deduction or itemize. That point matters because most retirees do not itemize. Most retirees are not playing the old game of piling up mortgage interest and charitable contributions and miscellaneous expenses and trying to beat the standard deduction. They live on fixed or semi-fixed income, they keep life simpler, and because the standard deduction is already relatively high, they often assume itemizing is a dead conversation. So when a new deduction arrives that sits on top of that framework and reaches both standard deduction filers and itemizers, you are not looking at a niche break. You are looking at a broad one. The income thresholds described in the source are $75,000 for single filers and $150,000 for married couples filing jointly. For the full benefit, with a phase-out above those levels, that means a great many ordinary retirees are not only eligible in theory, they are standing squarely in the middle of the target zone. Now, I want you to notice something important about how people behave around new tax rules. When something has existed forever, taxpayers assume it will be there. When something is brand new, taxpayers assume their preparer or software will automatically handle it. Those are both lazy assumptions. The first makes you complacent, the second makes you passive. Together, they create the exact kind of vulnerability that drains money. One April at a time, a married couple, both age 66, with modified adjusted gross income around $80,000, can look very different. Under this structure, start with the base standard deduction, add the extra age, based amount for both spouses. Add the senior bonus deduction for both spouses. Suddenly, the portion of income exposed to federal tax looks dramatically smaller than many retirees imagine. In some cases, it can wipe out most of the federal tax bill. In other cases, it can shrink it enough that other thresholds stop hurting you downstream. This is what people miss about deductions. They do not merely lower tax at the end. Sometimes they keep you from crossing lines that wake up entirely different tax consequences. That brings us to the third leak. And this one is my favorite because it reveals the difference between the amateur and the professional mind. I call it the income that never becomes income. Retirees who are charitable often make the same mistake savers make in every field. They do the right thing in the wrong order. They withdraw money from the IRA, they let it hit the bank account, they accept the taxable distribution. Then they write a check to the church, the hospital foundation, the scholarship fund, or the local charity they care about, and they tell themselves they have done the sensible thing morally, perhaps economically, often not. The qualified charitable distribution is one of those rare moves in the tax code that is better than a deduction because it attacks the problem before the problem appears on the return. If you are age 70 and a half or older and you have a traditional IRA, you may be able to transfer money directly from the IRA custodian to a qualifying charity because the money never lands in your account first. the amount transferred does not show up as taxable income in the same way. It can count toward your required minimum distribution while staying out of adjusted gross income. That is not a small distinction, that is a structural one. Once something lands in adjusted gross income, it begins touching other parts of your financial life. It can push more Social Security into the taxable range. It can contribute to higher Medicare costs down the road. It can interact with other thresholds in ways most people never bother to map. Retirees tend to think in terms of, did I get a deduction for the gift? The better question is, did I prevent the income from becoming a tax problem in the first place? That is the Buffett way of thinking. I am less interested in heroic rescue after the fire starts than I am in keeping the match from being struck. Take a retiree required to withdraw $14,000 this year from a traditional IRA. Suppose that retiree already intends to give $2,000 to charity. If the full $14,000 comes out first and then a personal check goes to the charity, the return can be worse than people imagine because the taxable income is higher and the side effects can travel further than the simple donation amount suggests. But if the $2,000 goes directly from the IRA custodian to the charity as a qualified charitable distribution, the retiree satisfies that portion of the required minimum distribution without adding that $2,000 into taxable income. In the same way, same generosity, different structure, better economics. I have spent a career studying how tiny structural differences create enormous financial differences over time. A business with pricing power and one without can look identical for a quarter and utterly different over a decade. A retiree who donates through the bank account and a retiree who donates directly through the IRA may both feel equally charitable, but only one of them is controlling the tax chain from the top. And there is a cruel little rule here you must understand. If you wait until the withdrawal is already in your account, the moment is past. The distribution must move directly from the IRA custodian to the charity. Once the retiree receives the money personally, the tax character changes and the elegant version of the strategy is gone. That is why retirees who want to use qualified charitable distributions should not wait until the last minute, should not assume their custodian will read their mind, and should not believe December 31st is a suggestion. Deadlines in finance behave more like gravity than advice. The fourth leak is the one retirees dismiss until the arithmetic embarrasses them. I call it the medical threshold illusion. People hear that medical expenses are deductible only above a certain percentage of adjusted gross income and immediately decide the hurdle is too high. That is one of the most expensive reflexes in retirement, not because the threshold is imaginary, it is real, but because the average retiree dramatically underestimates what counts as a medical expense and dramatically underestimates how much retirement health care already costs before anything unusual happens. Under the rules described in your source, unreimbursed medical expenses above 7.5% of adjusted gross income may be deductible when you itemize. The lazy reader hears 7.5% and quits listening. The disciplined reader starts adding Medicare Part B. Premiums count, Medicare Part D premiums count, Medigap policies count, long-term care insurance may count within age-based limits. Dental work counts. Hearing aids count, vision exams count, prescription eyewear counts. Certain medically necessary home modifications can count. Mileage to and from medical appointments can count under the stated mileage rule. Now let us slow down and think like adults. A retiree with adjusted gross income around $50,000 faces a 7.5% threshold of $3,750. Many retirees on Medicare are already halfway or more than halfway there before a single extraordinary event enters the picture. Annual Part B premiums alone can be substantial. Add drug coverage, add supplemental coverage. Add dental work, which so often seems to arrive in retirement like an unwanted relative. Add hearing aids, which can cost thousands and often arrive precisely when income is becoming more fixed, not less. Add vision care, add prescription copays, add the little things no one tracks because each one is small. The threshold stops looking high, it starts looking close. This is why I say retirees live in thresholds. The medical deduction is not merely about having catastrophic illness. It is often about having a year in which the ordinary costs of aging, care, maintenance, and treatment finally exceed what the taxpayer assumed was out of reach. But the tax return will not volunteer that conclusion. Somebody has to gather the evidence. Somebody has to total the premiums. Somebody has to record the dental bill, the prescription total, the mileage, the out-of-pocket hearing expense, the long-term care premium. Somebody has to compare itemizing against the standard deduction and ask whether this is one of the years in which autopilot becomes expensive. That is what good capital allocation looks like at home. A business that fails to measure costs loses control of margins. A retiree who fails to measure medical expenses loses control of deductions. In both cases, the money slips away not because the economics were impossible, but because the owner never looked at the right ledger with the right seriousness. Now we come to the fifth leak, the oldest one, the quietest one, and perhaps the most neglected. I call it the buried credit. Deductions reduce taxable income, credits reduce tax itself. That is a profound difference. When people over 65 hear about tax breaks, they usually picture deductions because deductions feel familiar. But the credit for the elderly or disabled, as described in your source material, belongs to a different species. This is not simply lowering the amount of income exposed to tax. This is reducing what you owe dollar for dollar, subject to the limits and rules that apply. And here is why it is missed so often. The income limits are low enough that many preparers mentally skip the calculation, especially if they assume the client probably does not qualify. The result is predictable. The very retirees this provision was built for, modest income retirees, who still face some tax liability, often never see it on the return. That is not a failure of law. That is a failure of attention. According to the source, if you are 65 or older or under 65 and retired on permanent and total disability with taxable disability income, you may qualify for this non-refundable credit if your income falls within the stated boundaries. The credit is calculated on Schedule R and then flows through the return. For the retirees who fit, this can be one of the most powerful tools in the entire stack because it does not merely shave at the edges. It can wipe out what is owed. Think about how absurd that is from the taxpayer's point of view. Millions of retirees spend years obsessing over investment returns, whether a CD should be renewed, whether the market is about to crash, whether they should wait 6 months before downsizing, whether the grandchild's wedding gift should be cash or bonds. And all the while, a buried credit may be sitting in the code like an uncashed dividend, ignored because nobody ever looked carefully enough. I have no patience for that sort of sloppiness. If a wholly owned business of mine were leaking money through 5 obvious places, I would not call that bad luck. I would call it a control failure. That is how retirees need to think. Your retirement return is not a ritual. It is not a spring chore. It is an annual audit of whether your household is preserving capital intelligently. This is why Barbara matters. Barbara is not memorable because she is unusual. She is memorable because she is ordinary. She is the retiree almost every family knows. The woman who worked for decades, played by the rules, relied on professionals, and assumed competence where there was merely routine. When she owed $900, but she should not have owed. The error was not philosophical. What's procedural? The age-based deduction had not been fully reflected. The new senior bonus had not been captured. Medical expenses were never run against the threshold. The buried credit was never checked. The return was filed as if retirement were generic, when in fact the code had written special rules for exactly her stage of life. That is what people miss about old age and money. Retirement is not simply a smaller version of middle age. The cash flows are different, the risks are different, the tax map is different, the order in which you draw income matters more, the source from which you make a gift matters more, the premium you pay for health coverage matters more, the forms you attach matter more, the thresholds matter more. Everything becomes less about expansion and more about sequencing. Sequencing is what preserves wealth. A young worker can make a great many sloppy decisions and still outrun them with time, labor, and rising income. A retiree has a narrower margin for error because the replenishment machine slows down. The retirement portfolio can still grow, of course it should, but the human capital engine that once corrected mistakes through extra years of work, promotions, and overtime becomes weaker. That means every avoidable tax leak deserves more respect. Now let me pull these 5 pieces together into a single operating system, because information without process is entertainment. Here is the retirement tax protocol I would use if I wanted to keep the IRS from becoming my silent partner. First, verify identity facts before you verify numbers. That means looking at age designations, blindness boxes where applicable, filing status, and whether the return reflects the taxpayer you actually are today rather than the taxpayer the software remembered from years ago. A surprising amount of money is lost because people audit the arithmetic but not the assumptions. Second, separate permanent provisions from temporary windows. The additional standard deduction for age exists as part of the continuing structure. The senior bonus described in your source is a temporary window. Temporary provisions are dangerous because they reward speed and punish inattention. If you qualify during a limited period and miss it, the code does not apologize later. Third, attack adjusted gross income upstream wherever legally possible. The qualified charitable distribution matters because it can reduce taxable consequences before they spread. In retirement planning, upstream decisions often matter more than downstream cleanup. Once income hits the wrong place, other dominoes begin falling. Fourth, treat health costs as a ledger, not as random pain. Most retirees remember the expensive dental bill and forget the monthly premiums, or remember the hearing aids and forget the prescription copays, or remember the stair lift and forget the mileage. The medical deduction threshold only becomes visible when the whole year is gathered in one place. Fifth, never assume a preparer has run every low-income or retiree-specific credit. Ask directly. Ask whether Schedule R was considered. Ask whether the credit for the elderly or disabled was tested. Ask whether itemizing was compared against the standard deduction after counting all medical expenses. Ask whether the new deduction described for seniors was applied. People are often uncomfortable questioning professionals because they confuse politeness with trust. I prefer trust that survives a checklist. That is the operating system. And now let us go one layer deeper, because the real power here is not merely in claiming 5 breaks. It is in changing how you see the tax code itself. Most taxpayers think the code is one giant penalty book. They see it as a machine for extracting money, a swamp of forms, a series of traps laid by humorless people. There is truth in that view, but it is incomplete. The code is also a map of incentives. It tells you what activity the government is encouraging, which category the government is trying to protect, and which taxpayers it knows are vulnerable enough to warrant explicit relief. Retirees over 65 occupy one of those protected categories, at least in part. The government knows older taxpayers are more likely to face fixed income, rising medical costs, required minimum distributions, vision issues, disability issues, charitable giving tied to tradition rather than tax planning, and a growing dependence on competent filing. That is why these provisions exist. The tragedy is not that the government failed to write them. The tragedy is that the average retiree is still filing as though none of them exist. That is why I like a checklist better than a slogan. Slogans make people feel informed, checklists make people richer. So if I were sitting with a retiree across the table, this is what I would ask. Are you over 65? And if so, is the return reflecting that fact correctly? If you are married, do both spouses qualify, and did the return capture both? If blindness applies, was that box checked or merely discussed? Did the preparer include the senior bonus described in the source when the income levels fit? If charitable giving comes from a traditional IRA, are you still writing checks from the checking account when the custodian could send money directly? Have you totaled every Medicare premium, supplemental premium, prescription bill, dental expense, hearing expense, vision expense, long-term care premium, and medically related mile for the year? Did anyone compare itemizing against the standard deduction after counting all of that? If income is modest, did anyone actually run the elderly or disabled credit instead of assuming it would not apply? If the return was already filed incorrectly, did anyone discuss amending it? Those questions may feel mundane. They are not. They are capital preservation questions. The retiree who asks them is not being difficult. That retiree is acting like the owner of the household balance sheet. Now let me say something that retirees need to hear. The most dangerous sentence in personal finance is not, "I cannot afford it." It is, "I'm sure my preparer handled it." Maybe the preparer did. Some are excellent, some are careful, some know retiree tax law cold and save their clients real money year after year. But confidence is not a filing position. Delegation is not verification. And when the rules are changing, when temporary deductions appear, when software needs updates, when the return is prepared in haste during a compressed season, the taxpayer who never looks is the taxpayer most likely to miss what was available. That is why I do not want you merely entertained by these 5 provisions. I want you changed by them. I want you to stop seeing the tax return as paperwork and start seeing it as a yearly negotiation between your life and the code. I want you to understand that the real difference between the retiree who keeps the money and the retiree who sends too much away is usually not intelligence, and certainly not virtue. It is whether someone had a system sturdy enough to catch what routine misses. Barbara got money back when the missing pieces were finally found. That is a happy ending, but it is not the ending I admire most. The ending I admire most is the one in which the error never happens. The retiree knows before filing. The transfer is made before the deadline. The premiums are tallied before the threshold is guessed at. The schedule is attached before the return goes out. The box is checked before another year disappears. That is how wealth is kept. People think wealth is built only by picking the right stock, buying the right house, or earning the right salary. Those things matter. But in retirement, wealth is also built by avoiding needless leakage. It is built by not paying tax you never owed. It is built by not converting carelessness into annual tribute. It is built by refusing to let complexity become an excuse for surrender. I have said for decades that risk comes from not knowing what you are doing. For retirees, that line applies to taxes as much as investments. If you do not know whether the age adjustment was claimed, there is risk. If you do not know whether the senior bonus was included, there is risk. If you do not know the difference between giving from your checking account and giving through a qualified charitable distribution, there is risk. If you have never totaled your medical costs because you assume the threshold is too high, there is risk. If you have never heard of the credit for the elderly or disabled, there is risk. And the cruel thing about tax risk is that it rarely announces itself dramatically. It arrives as normal. It looks like a routine payment. It hides inside professional confidence. It blends into April. That is why so many retirees miss it. Nobody steals the money in broad daylight. It drifts out in forms, omissions, defaults, and unchecked boxes. Do not let your money drift. Here is the final choice. You can file the way most people file, which is to hand your financial life to routine and hope routine deserves the trust. Or you can file the way an owner thinks, which is to understand where the 5 doors are, know when they apply, check whether they were used, and refuse to pay $1 more than the law requires. One path feels easier in the moment and costs more over time. The other path asks for attention, discipline, and a little discomfort. And it pays you back in the currency retirees need most: control. That is the real contract in retirement. Not a contract with the market, not a contract with Washington, a contract with yourself. You will not let ignorance pose as simplicity. You will not let habit pose as competence. You will not let another April arrive before you know which of these 5 provisions belongs on your return. Because when you are over 65, the game is no longer only about making money. It is about keeping what a lifetime of effort already earned.